All right, so welcome colleagues to part B of our lecture 1 in FAC 1503, this 2024 academic year, semester 1. So we were explaining in part A regarding to the forms of ownership and the users of financial statements. Right, so forms of ownership, there's 4 main forms of business ownerships, namely sole traders, partnership, close corporations, and companies.
Sorry, leader.
Yes.
Sorry, leader. I was kicked out
Oh,
for
yes.
a few minutes.
Yeah, no, I noticed.
Yeah.
It's because of the meeting limitations of Zoom. Sometimes it allows us to, to engage for like 45 minutes. So I did it that I took
Okay.
so that at least the recordings can come in 2 parts or 3 parts if it were. Because sometimes if it's 1 hour long, it can be tiring for one to be focused or glued on the screen when they are rewatching the recording. So that's why I try to, to keep them splitted into 3 parts or 2 parts like that. And maybe they will be 30 minutes long or so that it becomes easier for one to maintain concentration as they watch the recording.
Okay.
Yeah. So this is part B now, but of the same lecture lesson, and we're just really proceeding further. So, but I think for today, what I'll do, I'll focus only on learning unit 1, and then I'll get into what I wanted to get into in lecture 2, and that's where I'll be dealing with learning unit number 2. Because I just thought maybe it's good if we lay the theoretical foundation first, then we get to the practicals as afterwards. Right. So now, these are the 4 different forms of ownership, business ownership. Sole trader, partnership, close corporations, companies, right? So to explain them so you understand what they are. A sole trader, it's a form of business ownership whereby it's formulated by one individual. A good example of a sole trader, it's a spaza shop. So it's run by one individual. Everything, be it the expenses and the incomes of that business, they affect the owner. Partnerships, this is where you have 2 or more people coming together to form a business organization. But one element about partnerships, they don't have legal identity. And that's why you notice that even for tax purposes, a partnership does not pay tax, but the individual partners, they are the ones liable to pay tax. A CC, closed corporation, similar to a company. But nowadays, they no longer allow you to register a new closed corporation. They only allow you to register companies instead. And CCs, they are allowed to convert from CCs to a normal company, right? Now, who are the different users of the financial statements? So obviously, for example, you would have, let me do this so that I think it becomes easier for me here. I'm sorry. It's something I'm just trying to change. Okay, let me do this. Okay, better. Right. So with investors, here's what happens. So now I'm trying to explain to you the common users of financial statements. So you've got investors, creditors, employees, government, and management. So what I want to explain to you is, why are these individuals interested? I mean, these groups of users interested in the financial statements of an organization. Number 1, an investor is interested in the annual financial statements of an organization so as to make an informed investment decision in the company. I mean, you want to know whether the company is making money, so that when you put your own money, you will be able to have return on your investment. That's what is happening. That's why an investor is interested in the financial statement. So they want to know how the company is performing, whether it's making money. If it is, so they will be able to make that informed decision to invest their own money so as to have return on their investment. That's investors. Creditors, they're the ones that gives loans or that sells items on credit to the business. So when they want to look at your financial statements, the one fact they want to establish from that is to determine whether the company is liquid and solvent, or in other words, they want to establish whether you are able to pay them or you're able to afford to repay them the liability that you owe them. That's why creditors are interested in financial statements. What about employees, which is another group? Employees. Why are employees interested in financial statements? Simply because they want to know the future of their employment status. Is it safe to remain within this company? Or perhaps I need to consider looking for other avenues of employment. That's why employees are interested in the financial statements, because they want to know whether their future is safe, or their employment rather is safe within a particular organization. Government, they're interested when it comes to financial statements of an organization because of regulatory and compliance issues. So they want to know whether the company is complying to the laws and regulations of the country. Number two, they want to also know or be able to measure, whether the company is paying tax or not. That's government for you. Management is interested in financial statements because that is one way they will be able to know if they are performing optimally or they are underperforming. All right. So with management, it's always about performance of the company. All right. So when they look at the financial statement, they want to know how well are we performing as a business. Okay. Which areas do we need to improve now, based off on what is reflected in our financial statements? If our financial statement is stating that our profit decreased from the profit that we made last year, we as management will be keenly interested to improve our performance going onwards, because we cannot be finding ourselves going down other than going up as a business, right? So that's what management will be interested in the financial statements, right? Users of information. So you see these groups that you're seeing here, the groups of, or the users of financial statements, they can be classified as internal users and external users. For example, with internal users, the internal users is these ones: employees and management. Those are the internal users of financial information. And here they are: management or employees. What about external? External will be investors, creditors, and the government. Does it make sense, leader?
It does make sense, leader. Thanks.
All right, great stuff. Then fields of accounting, there are two types that you just need to remember there. So there's what we call financial accounting, which is what you will be focusing on throughout the entire of this module. Then there's management accounting, which is concerned with financial provision of financial information to people within the entity. So financial accounting, we are conveying the information to both internal and external parties, but mostly external parties, right? So that's where the difference is, right? Okay. Financial accounting, by definition, it's basically the recording of transactions and preparation of financial statements of the entity as a whole. And this process, by the way, of recording transactions in the financial statements, right? For external use, remember, the information is supposed to be conveyed to external parties. We are drafting or recording those transactions and preparing financial statements according to a specific benchmark, standardized benchmark, and we call that the International Financial Reporting Standards, IFRS. Whereas with a management accounting, there is financial information, yes, that is recording, but there is no specific benchmark that we have to necessarily oblige to. Hence, they're saying managers use this information in their decision making. So the key or the core behind management accounting information is for decision making, so that we can be able to what? To achieve our set objectives as an organization. Notice there is no standard that is governing how that information is to be presented or generated as such with regard to management accounting. But with financial accounting, the information is recorded, prepared, and reported in financial statements according to a specific benchmark, which is what we call the International Financial Reporting Standards. It's very important to pick up the differences there, right? So hence I was emphasizing, of course, earlier to say, look, the emphasis will be on financial accounting and not necessarily management accounting. All right, So that was just to point out on some of those basics. Now let's talk about internal controls. So with internal controls, my brother, so that you understand what these are, like any other business organization, okay? You cannot run your business without rules of conduct, without having mechanisms, okay? You cannot run your business without certain mechanisms, rules and procedures, all right, in place so that your information or so that your business activities, they are done accordingly. You need to have certain mechanisms, you need to have certain rules in place, you need to have certain procedures that are in place so that whatever you do as a business, it's being done accordingly, or it's done directed to the achievement of your objectives as a business. So that is where internal controls comes into the picture. So internal controls can be attributed as three things: mechanisms, rules, and procedures, which are put in place by an entity to ensure the integrity of financial and accounting information, as well as to promote accountability and to prevent fraud. That is the whole purpose behind internal controls. So we put certain controls in our organization so that at the end of the day, we have integrity in the information that we produce and report to the interested parties. And we also ensure that there's adequate accountability in place and prevention of fraudulent activities. Now, these internal controls, they come in different forms. It can be in form of a policy that is drafted that everybody have to comply with. It can be in form of standardized procedures that we have to follow. So notice there, how do you prevent fraud? There has to be policies that you put in place, which everybody in the organization has to comply with. The moment they override policies, and normally that's management, then we know that there's fraud that they are trying to perpetrate. Or then we know that there's abuse of company resources that is being perpetrated, right? So that in any case, for the purpose of this module, there are two groups or classification of internal controls that you need to know. So you've got what you call built-in control measures. All right. So built-in internal control measures, my brother, these ones are programmed under normal circumstances. So when you are creating documents, you program them along with, they're programmed within a system so that when you produce certain documents, they are already there. So these are built-in internal control measures. For example, if you've got source documents, right? Source documents have to be numbered. So if I've got an invoice, for example, that I draft for you, you'll notice that there will be an invoice number that is already there when I print out the invoice and I issue it out to you. So what is that invoice number there? That invoice number, it's a built-in control measure. So it's something that has already been programmed within the system. And if I'm to present it in form of documentation, it will be reflected on that document. So those are what we call built-in control measures, right? So there's, documents should be numbered, dates on the source documents must be reflected, control accounts in respect of clients and trust creditors should be there. We need to have those control accounts, right? That's why there's ledger accounts, by the way. There are forms of control accounts so that we can be able to control what is happening with regards to to the affairs of our clients. We need to have separate bank accounts, right? As an attorney practice, you need to have a business account. You need to also have a trust bank account, right? The keeping of petty cash according to the interest system, the accurate analysis of all income, all these, by the way, all these built-in control measures, you need to know them for a purpose of a question you'll get in assignment 1. I can bet on this. You'll get it in assignment 1. So what you need to know, they can ask you to identify a combination of built-in internal control measures. And they give you combinations. And what they will do, they will have a combination which is correctly attributed to built-in control measures, but they would have combinations where they will mix them with internal control systems and procedures. Now, these ones, automatically you know that, okay, this cannot be a built-in control. How do I know it's not a built-in control? Because a built-in control, normally it's something that is already pre-planned, pre-programmed under normal circumstances. Whereas with internal control systems, or procedures. These are more like policies, instructions that are given that have to be followed, which can be, number one, separation of duties, access controls, physical audits, standardized documentation, trial balance, periodic reconciliations and approval and authority. These are not programmed. These are not built-in controls. These are standardized procedures, instructions that we give. Say, this is what you need to do. This is how it's supposed to be done. Whereas with these ones, under normal circumstances, we've already pre-planned everything. Everything is already in place in form of documents, and which are already, have those built-in internal controls in them. That's where the difference is between built-in controls and internal control system or procedures, right? Are we together? So
we are together, my leader. I can hear you clearly.
Perfect. So these are the typical examples of internal control procedures, right? So efficient banking of all cash, all payments must be made by EFTs, proper authorization for all transactions. So these are like policies, my brother, in simple terms. So notice they can ask a question in the MCQ where they are talking about built-in control measures. Then they give you a combination maybe of these first two, and then they bring in other items from there. So you already know that, okay, no, there's a problem there. It cannot be a built-in control measure, right? Correct. So then, of course, you now need to know. So it's important to just know this for assignment purposes. You can even refer to your source material as you do the assignment, because it's not like a closed book assignment anyways, right? So, but I'm just trying to show you where the information is coming from. And then, of course, let's talk about financial frameworks. I mean, when you do financial reporting, it's governed by certain rules. It's governed by certain principles, right? So when it comes to accounting, in particular, and to be more precise to the fraternity of law, we are, or legal practice rather, we are supposed to comply with rule number 54.6 of the Legal Practice Act, which requires every firm to keep in the official language of the Republic such accounting records, which records both what? Business account transactions as well as trust account transactions. So that is the whole purpose behind we as art and practice having to generate financial reports or financial statements. So it's because of this rule number 54.6 of the Art and Practice Act. Now, let's talk about the financial frameworks now, or the accounting frameworks that we have to follow. So there's what they call the IFRS, International Financial Reporting Standards. And then there's what they call International Financial Reporting Standard for small and medium entities. So there's, which is also abbreviated as IFRS for SMEs. So these are the frameworks that we follow, the accounting frameworks. But in the context of art and practice, you just need to know that it's IFRS. The International Accounting Standards Board issues these frameworks. So notice the frameworks is the IFRS or the IFRS for SMEs, but who is responsible for issuing them? It's the IASB. They are the ones that issues these writings or these standards. So it's important to disseminate the differences between the two. Because sometimes they can ask you to say, who issues the financial frameworks, and then they give you IFRS, they put IFRS for SMEs, and then they put ISB, and then they put something else as well. So you need to be able to know the differences. So this accounting board, IASB, they are the ones responsible for issuing these financial frameworks, right? So a financial framework here is just a standardized format that has to be followed when you're structuring your financial statements, basically, right? Then conceptual framework. This conceptual framework, it's it's your accounting rules and interpretations of certain accounting theories. So that's what the conceptual framework is all about. And what you need to understand or draw from the conceptual framework is that it's a group of interrelated objectives and theoretical principles that serve as a frame of reference for financial accounting, and more specifically for general purpose financial reporting. Anyways, from there are certain principles that you'll see, which I'm going to talk about shortly. So I'm just going to skip a few of these so that you can see the, so that you can begin to see those principles. So there's what we call fundamental theoretical principles that all general financial statements must be based on. All of these fall under the conceptual framework. Right. So what are those underlying assumptions? The two underlying assumptions, so you need to know the two underlying assumptions. So there's what we call the going concern assumption, and then there's what we call the accrual basis. Now, going concern assumption is that with going concern, when you're talking of going concern, you're simply just dealing with the expectation that an organization would continue to exist or would continue to operate in the foreseeable future. That's what going concern is all about. It's all about it's about determining on whether the organization would continue to exist in the foreseeable future. Accrual basis, it simply means we record events, as they occur, and also not necessarily when the actual money is received. So we can have a transaction occurring now, but the payment for that transaction taking place 3 months down the line. So what accrual principle or accrual basis requires is that we record the transaction as they occur and not necessarily as in when the money is actually paid. So we record the event today, even if the money is to be paid later. That's accrual. So it takes into account actual payment now and payments being done at a later stage. That's what accrual is. Accrual principle really entails. So notice there are two assumptions here. There's underlying assumption, and then there's what we call fundamental qualitative characteristics. So there's what we call relevancy. So when it comes to the relevancy characteristic, the information that is supposed to be conveyed in the financial statement, it should be information that pertains to the entity in concern, and it has to be material information. That's with the relevancy principle. Faithful presentation, it just means we have to produce information that is truthful, okay, to our users. So those are the fundamental qualitative characteristics. We talked about the underlying assumptions, two of them, going concern, accrual, and accrual basis. Please don't forget this. You'll be asked about these things in MCQs, right? Then, of course, we've got materiality that is emanating out of relevancy. So there are two things that comes out of relevancy: materiality and the nature of information. So with materiality simply means that the information has got a significant effect or significant impact. So if something is material, it means it has got a significant effect. So if it has got a significant effect or impact, it has to be presented in the financial statement, right? But it also matters the nature of information. Is it financial or it's not? See, if it's financial, then obviously, yes, it can be conveyed in your financial statements. Completeness. Notice completeness, it's coming out of faithful presentation. So with faithful presentation, we can only know that the information is truthful if, number one, the information presented is complete. If the information is neutral, meaning to say that there's no, bias bias elements that we can identify from it. And also, if ever, the information conveyed is free from error. If the information is free from error, if the information is neutral, meaning to say there is no bias or conflict of interest somewhat that is seen in the information presented, and if the information conveyed is complete, then it means that the financial statements have been faithfully presented. With relevance, remember two things. Information is relevant if it is material and if the nature of the information is financial, right? Helps the user to make informed decision, right? So it's very, very important, my brother, to remember these principles. All of these, they are coming from fundamental qualitative characteristics. We're almost done, so you don't need to really worry. Then there's what they call enhancing qualitative characteristics. Notice we just finished discussing about fundamental qualitative characteristics. Two of them, relevancy and faithful presentation. And out of them, we see that there are other characteristics that emanate out of them. But then there's fundamental, so there's enhancing qualitative characteristics. So yes, as much as we're fundamental, but we also have to have, enhancing qualitative characteristics. What are those? Information conveyed in the financial statements must be comparable. In other words, there has to be comparability. We should be able to compare that information between different entities and different time financial periods. And it should be verifiable. We must be able to have, independent observers coming to verify the information. That's where auditors comes into the picture. And it should be timeliness. There has to be timeliness. When we say that the information should be available in time, so that the ones that are intended to use that information, they can be able to use, they can be able to take informed decisions. Understandability, what is it? Understandability, meaning, right. Understandability, it means then the information must be clear, concise for the user to understand what is conveyed there. It should not look vague. Are we together?
Brother, we are together.
Perfect. Right. So it's purely theoretical, but I was just trying to, to endeavor that you understand what is happening there, my leadership. So there are some things I'm going to be skipping, but I'm not going to skip 1.6 because it will build up on what we'll deal with in number 2, learning unit number 2. So my brother, there's such a thing when you're dealing with financial statements, right? Like I said, there are more than what? There are more than 2. But the most common one that you need to know for this module is this one: statement of financial position and the statement of profit or loss. That's what they are dealing with a lot in this module. But there's also such a thing called statement of changes in equity, statement of cash flows, and then, of course, together with that, there will be notes to the financial statements. Now, this is not a financial statement. This one, it's not a financial statement. It's notes to the financial statement. So what that does, it amplifies what is conveyed in the financial statement. That's what notes to the financial statements do, right? But the most important thing I want you to pick from this is the elements of the financial statement. So there's assets, liabilities, equity, income, and expenses. 1, 2, 3, 4, 5. Okay, there's one that okay. I'm trying to look for one. Okay, but I don't know why they've not indicated yet. There was supposed to be drawings, but it's part of those that is affected by equity. Right. So those, yeah, it's one of those that is supposed to be reflected there, but I don't know why it's not showing.
Okay.
Yeah.
Hello?
Yeah, no, I'm still there, leadership. I'm still there. Right.
Okay.
Perfect. So we're going to be talking about that in a greater detail in learning unit number 2. But anyway, like I mentioned that the elements to the financial statements are grouped into 2 headings. Those that pertain to the financial position and, of course, the financial performance. I've already explained that aspect to you earlier. So here's what happens. In your in your basic accounting equation. So, okay, but this can be complicated for you to understand. But basically what you need to draw from this is that assets is equals to, so is that assets, sorry, not assets. Let me just correct this. So this is equity plus, okay, no, they're showing it very different from what I normally do, but it's fine. So statement of financial position at the beginning of the period, assets minus liabilities equals to equity. So yes, this is equity, of course, plus statement of financial position, income minus expenses. Okay, so it's still part of equity anyways, this one. And then plus contribution, all of this is equity, by the way. But I don't want to confuse you, leader, on this on this part. Let me not confuse you, right? But the most important thing that you need to know with the basic accounting equation, it's just basically this. Assets equals to equity plus liability. That's how the basic accounting equation operates. That's what you need to know from this. So this can be complicated to understand, but in simple terms, yeah. But what I know, I understand what they're trying to explain to you. So what they're trying to explain here, when they're saying this plus that, this is equity that they're explaining. So equity, number one, it can be the difference between assets and liabilities. And it can also be the difference, adding to the equity, you would have, in fact, let me do it this way so that it becomes easier to understand. So what they're simply trying to say to you, I think, let me explain this so you understand that table. Right, so equity works like this, my brother. Because I really think it's important that I explain it. So now the first part there, they're simply saying what makes up equity. It will be involving the difference between assets minus liabilities. And number two, it will also involve the difference between incomes and expenses. All of this would affect your equity element. And then number three, it will also involve contributions by the owner.
So basically, my leader, if we are
Yeah.
saying assets minus liability,
Yeah,
so what will remain there is going to be your equity.
it's going to be your
When-
equity. Exactly.
Okay.
Yeah.
Income minus expenses, what will remain probably as a profit.
Yeah,
After,
which will be added to equity as well.
Okay.
So obviously this will be equals to profit. This one, from the basic accounting equation perspective, it will automatically give you equity.
Okay.
Yeah. So, and then the contributions by the owner minus drawings, it still gets you to equity anyways. So all this would affect equity. Why they're explaining it that way? So that when you now doing the when you're accounting for the effects of transaction of the basic accounting equation, let's say you get a transaction that involves income. How would you affect? Where do you reflect income here on the basic accounting equation? Because it's definitely an income is not an asset. It's not liability either. But what it affects equity. So obviously, if I have an income and then at the bottom of it, I have a transaction concerning an expense, then I know one transaction will be a plus to equity, one transaction will be a negative or a reduction to equity. So which one is the plus to equity? It's obviously the income transaction. Which one is the minus to equity? Obviously, it will be the expense. So that's what is being reflected by this. Do you see it?
Yes, leader, I can see it.
Yeah, but I know for now, because it's still theory, you might not get it yet, but that's one of the things you understand better when I get to learning unit number 2. So when I begin to explain dynamics around learning unit number 2, it's easier for you to understand how these, 3 aspects to equity, fit in. So basically what these are just, ways in which equity can be affected. So equity can be affected by just simply looking at the difference between the assets that the company has minus the liabilities. If we've got incomes and expenses involved, we just simply look at the difference between the income and the expenses. Whatever that is left is, if it's profit, obviously, then of course, it will be a plus to equity. Right?
Okay.
Yeah. And then if there was contributions that the owner of the business made to the business, so that would be a plus to the business. And if there was drawings that maybe took place, then that would be a minus to equity. Yeah. Yeah. So these are just effects to equity. Let me put it that way. Effects to equity. Yeah. That's what they're explaining to you here in simple terms.
Okay.
Right. Then there's don't worry about this much, the statement of financial position. These other aspects, These are just theories. Right. Okay. Just a sec, leadership.
Okay, leadership.
Thank you. What about that, leadership? Right. Then, of course, so here what they are just trying to explain to you about the statement of financial position. They're simply trying to explain what it conveys. That's what you see here, but not so important. But then the elements you see from the statement of financial position, it's assets. You need to know the definition of an asset. So it's a present economic resource controlled by the entity as a result of past events. And it will be expected to bring in future economic benefit. That's the aspect you need to know about an asset. Then liability is also another element which you see in the statement of financial position. So a liability is just basically debts that the organization has. And here's the definition: a present obligation of the entity to transfer an economic resource as a result of past events. So what a liability really results in is outflow of economic resources, but it's as a result of what happened in the past, which created or generated a present obligation. Then, of course, there's owner's equity. Right. But already when I'm talking about this, I'm introducing you to this. Because when you talk about the double entry principles and all, we will be looking at those elements of financial statements that I'm talking about now. So, but what I'm thinking we should do, my leader, because this, I will need to give you details. I don't just want to touch the surface of definitions and all, because it's a build up anyways into what I'll explain to you in Learning Unit 2. Okay. So what I would rather do, I think for today, I would leave it here. And then when we carry on in our next lesson next week, we'll just start from here. But I've already prepared anyways for you pertaining to these aspects about the elements of financial statements, which I'll share with you, and then we would use that as we engage. Yeah. But for today, I think let's end it here. I don't know if you've got any questions, areas of clarity that you want me to clarify.
No, so far so good, my leader. But
yes, sir.
I'm looking forward to understand the exact principle, because I think I need to know. Probably I have to focus and understand more. I got the what you call now the foundation.
Yes.
As we have explained, going forward as we are doing it practically, that's where the problem starts from. Learning 2.
Yeah.
Going forward,
yeah.
If you miss, as we have said,
yes.
If you don't understand Learning 2.
Yeah.
So that's a problem. So to me, I'm looking forward to it.
Yes,
so I
exactly.
understand the principle exactly.
Exactly.
of this exercise. From there on, I think it's gonna be
absolutely. So absolutely, leadership. So I think let's carry on from that next week, and we lay the foundation. We might do a couple of sessions just only on Learning Unit 2. Probably we might have like 2 of those, lessons of just one topic, so that you really have a good understanding of what is happening before we can even go to other topics. Because as I emphasized earlier, it is the foundation of every other topic that you will do in the module.
That's good, leader, because I want to be in the position to be able to identify exactly what is assets is, probably in a given question.
Exactly.
Liabilities.
Yeah.
Once you know those things and classify them accordingly, I think it's going to be simpler going forward.
Absolutely, leadership. Absolutely. All right. No, thank you so much, man, leader. So I'll upload the recordings to the YouTube platform, and then I'll share the recording with you on the group.
Thanks a lot, my leader, for your time and everything. Have a blessed day.
All right. Cheers. You're welcome, sir.